Hello traders, so welcome to another lesson. So in today's lesson, actually we are going to be talking about the weekly and daily bias. And when I say the weekly and daily bias, what I mean is where is the market likely to go. So actually this is one of those lessons that you want to simplify everything, keep it very simple. So the process I'm going to outline in these lessons is all you need in terms of determining your weekly and daily bias. So let's begin with the weekly bias, because we'll need to determine the weekly bias before we can determine the daily bias. So we'll actually be using some of the concepts that we have already learned, like the order flow and a bit of bank sponsorship, to aid us in determining maybe the likely direction of the market. So to begin with, we are going to explain the weekly range. So the weekly range is simply in a typical candle in the market. You have the opening, you have the low, you have the high and the close of that candle. So I've tried to outline here how it may look like. So we have the opening. So I'm using Sunday open because that's the opening you're going to be focused on when determining or maybe following the weekly bias. So the typical weekly range will look like this. So this is a bullish scenario. So the bearish scenario will just be the opposite of this. The opening will be up here and the close will be down, and then the high and the low remains the same. So when looking at this candle, you see that the market opened, then went lower, then it came all the way up, created a high, then come back down and closed. So that is actually the typical weekly candle or the weekly range. That's how typically it will look like. So we'll be looking at what the Sunday open is. So the market will open, potentially it will go low. So this is assuming we're bullish. Potentially it will go lower, then come all the way, print a high, and then come down and close the wick. So that is typically how the weekly range will look like. So what you want to be doing every week, maybe preferably during the weekend, you want to determine the likely direction of the week by looking at where the market has been and where it is likely to go. So using the concepts you have already learned, preferably order flow, you can use premium versus discount, premium and discount, or premium and discount. So those are the kind of things you can be using to determine the likely. So you're not trying to be perfect in terms of gauging where the week may go, but you're trying to determine the most likely direction that the week may go during that week that you're about to enter. So when you're doing it in the weekend, the very week, the trading week you're entering, you've already done your analysis and you're determining maybe potentially it will do, maybe this move will occur. So in determining the weekly direction, it is crucial to understand the previous week's data. So when you come into the charts, maybe during that weekend you're analyzing, you want to understand what the weekly has been doing. So if you are following the markets consistently every week, probably it will not be changing so much. So you'll be keeping track of what the week is doing every week, maybe what you anticipated and what has occurred. So, but if maybe you've had an extended period of time before being in the markets, then you'll need to come back and check where has the week or the weekly candle been coming from, or the weekly range been coming from, and then you determine if there's any key level that has been hit in the market. For instance, in this example, you have a monthly fair value gap that was hit, and then the weekly now started moving higher. So this is the EURUSD monthly chart. So the monthly chart hits this monthly fair value gap, and then it started rejecting. So the nearest place that we are going to be looking at is the equilibrium of this range. So this is the last range that the market has been working on. It has been dropping with an order flow that is dropping, and then at this point it hit this time frame fair value gap. We see rejection. So from this rejection, the next month we're going to be looking for higher prices. Now we'll go into the weekly, but this will aid us in determining probably what the weekly is doing. So it may hit a fair value gap or an order block, or sometimes it might even just take out liquidity. So this process is important actually in order to anticipate the likely direction of the week ahead. So let's drop to the weekly chart so that you can see maybe clearly what we are referring to. So once we hit that monthly fair value gap, this is the weekly chart. We hit that monthly fair value gap. Then you see break in structure, break in structure, break in structure. So every short-term high were being broken and the market was leaving imbalances. So this is order flow. So actually, as we outlined in order flow, we are seeing the market starting to respect order flow. So it will be targeting these highs, this high, and potentially this high. So you have to check that you're now in premium, but you don't want to force the market to turn here just because it is entering premium, because sometimes you might not really know which level it might turn from, and it might go as high as taking out the liquidity, the highest high. So once the order flow is established, that's why we are outlining that you should follow this order flow. As long as it is going higher, follow the order flow and mark out potential targets until this market shows you clearly that it has changed order flow. So essentially that is, maybe if we can go back, I can mention that maybe when you're in this week, for instance, when you have seen this imbalance, this very week, when you come into the market after this candle has closed, this next week, you are anticipating that the market may come back to this imbalance, retest it and continue higher. So already the market has shown you that it is going higher. So you are anticipating that the order flow will continue higher, but you have to have reference points where the market may come, revisit, then turn from there. So your setup actually opportunities will come when the market comes into that imbalance and then it reverses. So your setup opportunities begins when the market reverses. Yes. So defining the Sunday open. So essentially this is the opening price that occurs just after Friday's close. So I've outlined actually here, this vertical line represents the Friday's close at 16:00 New York time. And then the very next candle is the Sunday open at 17:00 p.m. So that's the candle, actually the opening price of that candle. That's what I've outlined as the Sunday open. So typically it will occur at 17:00 p.m. UTC New York time, and this is a very key reference point actually in determining if our anticipated weekly bias is being respected or not. So we look deeper into how it will aid us in anticipating the weekly bias. So you want to actually outline this Sunday open using the 1 hour chart. I found that to be the best time frame that you can check quickly the weekly range in lower time frames. So this is a bullish example. So this was a bullish week. So we had determined that the market was bullish, and then we had this daily order block that we were watching. So when the market opened on Sunday into Monday, we're seeing that the market rallied higher and then it dropped back below Sunday open. So it initially went above it, took out some liquidities, and then it came back below Sunday open. So actually what I found to be very, very effective is you want to see the market between Monday, Tuesday or Wednesday come back below Sunday open. So typically you are trying to aim for that low of the week between Monday, Tuesday or Wednesday, and it should hit a higher time frame, either order block or fair value gap. And then from that order block or fair value gap, now that's where you base your entry on. That's where you base your setups from. So essentially you'll want to see it react off. Typically by Wednesday New York session, it should have reacted off and started going higher to create the bullish candle or bullish weekly range. So just the opposite for bearish scenario. Now a scenario where the market remains at or near Sunday open, if it just consolidates near it, even when Wednesday comes during New York, it keeps referring back to the Sunday open, then potentially that market is in a consolidation week. So you'll see that the market will just maybe form an indecision candle in the weekly chart. Actually, when looking at this day, this was a Wednesday and this is a Tuesday. So initially we dropped below Sunday open. We were bullish this week, but the market dropped below Sunday open on Monday and Tuesday, took out this liquidity on Tuesday, started going higher. So it traded below Sunday open on Monday and Tuesday, which is what we are anticipating. Then it has started going higher. Wednesday came back around during New York, started going higher again on Wednesday. So this is a very good indicator that it might go and maybe fulfill a weekly objective. But we're seeing on Thursday during London, the market comes all the way back to revisit the Sunday open. So this is not what we want to see if we are bullish. So Thursday, this created a reversal on Thursday. So essentially, that was the end of the weekly range. So it printed the weekly range on Thursday during London, the weekly high rather. So essentially by Wednesday, this continuation should have continued into Thursday and Friday, if truly that week was a bullish week. So essentially the anticipation of the weekly range is actually very crucial in knowing how we are supposed to trade for the entire week ahead. So once you have that anticipation, you just check those scenarios that we have outlined to gauge if that bias or that anticipation that you have is being fulfilled in the marketplace. So I have an outline here of how you can define your weekly bias, or the process you can follow to define your weekly bias. Essentially, what this process outlines is what you could be following throughout maybe every weekend when you're doing your analysis. So this is just an outline of what you could be doing, but it does not mean that once you get these concepts, you cannot come up with your own process. So this is just an example of a process that you can use to come up with a weekly bias. So the first thing you want to be doing, actually I'll be giving an example at the end of this lecture. So you'll get a live example at the end of the lecture. So every week, we want to determine the likely direction of the week ahead. Even before the week starts, you want to determine where is the market likely to go. So you start by defining the likely monthly drawn liquidity. So this is actually something that will not be changing so frequently, because the monthly chart doesn't really print so much within, maybe it could even, it's actually 4 weeks. One monthly candle is 4 weeks worth of data. So essentially you're not doing it all the time, but it's something you do once and you update as the price keeps on moving. So this, maybe in the monthly chart, maybe you could have an order block, a fair value gap, or a liquidity that you are aiming for, because the market has hit an opposing order block, fair value gap, or liquidity, and it has shown sponsorship away from it. And then once it shows that you are seeing that the market is responding and it's potentially aiming for a certain target in the monthly chart. So that target is what you'll be aiming for as a potential drawn liquidity in the monthly chart. And then now the market shows a willingness to move that towards that monthly draw from that opposing order block, fair value gap, or liquidity in the monthly chart. So, and then what you want to do, you want to drop to the weekly chart. So in the weekly chart, you identify any fair value gap or liquidity available in the direction of the monthly draw. So actually the monthly target could be further from what the weekly is showing. So you want to start with what the weekly is showing you, the fair value gap or order block or liquidity in that direction of the monthly draw. So this will be your potential targets. So what you want to do is look for market structure shifts that have occurred in the weekly chart towards that monthly drawn liquidity. And then look for signs of bank sponsorship. So we have already looked at bank sponsorship leading towards those fair value gap on the monthly and weekly chart. So you want to see bank sponsorship leading towards that drawn liquidity in the monthly chart. And then the order flow should be established towards that monthly draw, and new fair value gaps and order blocks should be created and confirmed towards the monthly draw direction. So these new fair value gaps and order blocks, actually these are opportunities for you to position yourself and trade towards that drawn liquidity. And that is how you define your weekly bias. So you do this every week, and then you'll keep on getting better at it. So the more you analyze, the more you backtest, the more you journal and record every week, the better you'll get. So that is actually a challenge to you, that you need to get in there and just do it yourself, because even though I've outlined your process, it might not really work unless you go into your charts and do it. So I'll be showing an example of how you can go through this process and how you can define your weekly bias. So you can go into your charts, annotate each week your anticipated weekly direction. So this is just an exercise. From the beginning of the week, record the actual delivery at the end of the week. So you want to see how the market is delivering and how maybe your anticipations based on how it should deliver. Then you record at the end of the week how it delivered. And by doing that every single week, you'll be getting better at anticipating what the price might do, and you'll be seeing exactly what prices do in the weekly chart and the daily chart. So record in your journal what you anticipate and what the market actually did. So also the monthly, you want to be recording every month what the market, maybe the anticipation you had, maybe the drawn liquidity, and how it went to that draw and what happened after you hit that draw. So follow the process outlined in these lessons. Also look out for an example that I've outlined the entire process and how you can maybe do your analysis every weekend. So thank you so much for watching. Look out for the live example right ahead. Thank you.